We don't,
It's a real one.
we don't decorate, we just do the tree.
That's all we do.
And I don't have anything to do with it.
You think it's been 30 seconds?
All my gifts are bought too. I finished up last night.
Wheels up.
There we go.
Goes up, so I think it's been 30
All right.
seconds.
I get stressed out. I don't get it done by Thanksgiving.
We'll call to order the meeting of the Longview Firemen's Relief and Retirement Fund. I want to thank everyone for being present here today. I do want to apologize for the late start. We did have a little bit of a early morning tragedy. The pension office was ramsacked with all the other offices in the building, so a little late start as Pam is working her way to the City Hall at this time after she deals with the proper police reporting and such. Will, can you hear me?
Yes, sir.
Is it okay with you if we have Ari Rastegar here, if we let him go first, or do you have another meeting behind that you would like to present first?
No, sir. I'd be happy to go after Mr. Rastegar.
All right. Well, that being said, we'll go ahead and move to presentation B, update on the Kyle project. Mr. Ari Rastegar.
Hello. Mr. Harrell, how are you, buddy?
I am well. I am busy, and I am remote.
Yeah, well, you are very busy. First and
This
foremost,
rolling
thanks-
stone gathers no moss.
Amen to that. Thanks for having me today. I like to, when you see all these headlines of the doom and gloom and the rates going up and the office market going to, you know what, I figure sometimes it's nice to get to talk in person a little bit about the things that are going on. We've very much been contrarian investors for most of my career, and this is one of those times that I think we've got it right. A lot of times we haven't, but this time we're in a pretty peculiar situation because, as you saw, for a little bit of mumbo jumbo, if that's okay, we think that this pause in rates might not be a pause. We think that there's a possibility that there still could be some hikes. And why do I say that? In our business, the borrowing capabilities is really what allows you to garner the outsized returns. To where if you don't have that capability, it poses a lot of different problems. If you look at your portfolio, and I'm by no means an expert there, but you can see the overall return structures that y'all have had over the last 3, 4, 5, 6 years with liquid securities. Sometimes with alternatives, the returns you get in alternatives for being illiquid don't merit the risk, in my opinion. And I know that might be a little counterintuitive, to what we're doing, but there's a time and a place that we believe that makes sense. So the project that y'all initially invested with us in Kyle, Texas, I don't think that we're smart enough to have got it as right as we had, quite frankly. I think having Tesla recently announce that they're moving one of their largest offices in America effectively across the street has posed a catalyst of growth that we were very comfortable with the project. We're in the middle of construction at the moment of building all the infrastructure, and I would love for any of y'all to be our guest at any moment to be able to see this. We have some updated drone footage that I could provide to your consultant, and he can maybe show y'all. And if y'all would like to come down, there's nothing like seeing it yourself. A couple things that have happened that were pretty remarkable is we signed the 11-acre donation to the city of Kyle to build the new elementary school on our property. And on its face, the value of the contribution was close to $2 million of the 318-acre parcel. But if you go back and you look at the values of real estate in general around elementary schools, not middle schools, not high schools, historically, the values have not only stayed steady, but they've outperformed a lot of the ancillary areas. And a lot of times, you're investing corner to corner, and just saying a city is not always indicative of the whole story, as we know, as you drive through. And to me, very much our strategy has been a little simple of following jobs, following growth, and then good old-fashioned walking the neighborhoods. Because a lot of times you look at the spreadsheets and you look at the numbers and you show up there and say, okay, well, something ain't exactly right about this. So in Kyle, we said, okay, if we could actually go and truly build an actual community without going too Elon Musky of, I don't have the stomach for some of the stuff that they do. But I looked at it and said, okay, if we could build a new school, if we could build some new apartments, if we could provide 60 acres of green space, and if we could slightly design the neighborhood in such a way that would ensure that neighbors get to know each other, if that makes sense. And so we believe a lot of things that have been lost in the, and not picking on D.R. Horton or Lennar or some of those groups, is the sidewalks, the alley-loaded houses where folks used to ride bicycles, certainly for us, and you walk through some of these neighborhoods, and you can tell that someone made it on a spreadsheet. I don't think some of these folks really were cognizant that real human beings are going to live in these houses, or what would be homes. So you look at the overall market now, and people aren't building. Why? Because interest rates are too expensive, so it's destroying their returns. But if you look the other way and say, okay, over the past cycles, 2007, 2008, 2009, in recent history, the folks that actually did build during the times when nobody was building, the demand that those properties had, if you fast forward a couple years in the future, was a dramatic difference. For example, we went ahead and secured a line of financing to build Gristmill Road, which is the main corridor of Kyle. So when we first bought the property, Bunton Lane was the main corridor of the city. But because of the sizing and the growth, they had to transition that to another road corridor, and I can show you this on a map at one point, or if you come out, I'll show you in person. For Gristmill, which would be the Park Avenue of Kyle, let's just put it that way. We decided to start and build this main corridor because Gristmill goes here, stops, and then it continues over here, and then there's this 318-acre parcel that runs dead in the center. So we thought, okay, if we build this first road and do the infrastructure and be able to activate the 1,000 individual home development sites, the apartments, the retail, and be able to allow the elementary school to start building, we can sit back and see what the timing should look like, because the value creation of activating those parcels is dramatic. So when we went out to get the financing, the rate was too high. And so I basically asked the banker, what would bring this down? He's like, well, put yourself in our shoes. How do we know we're going to get our money back if the land isn't cash flowing? Fair question. So we went out to the national builders. Green Brick, which is competitive to any of the names you might have heard of, wanted to buy about 270 lots of the 1,000. Mind you, you got another 1,400 multi-units and another, give or take 700 plus lots that would be available if we sold those, which is the business. Well, they didn't want to buy the lots unless Gristmill was built. The bank didn't want to finance Gristmill unless they bought the lots. So we had a little bit of a chicken and the egg problem. We got to know them pretty well, shared with them what the vision was, and they took a leap of faith with us and signed the contract to purchase those 270 lots, which allowed us to procure the financing for a line of about $16 million to build this road, which would create massive value creation, simply because if you have just a big piece of land and no one can get to their lot, so to speak, the value isn't as high if they can just pull up there and we can put wastewater and bring all the infrastructure. So we're well on our way to developing that. And the cool thing is, as soon as that road is done, this first piece in the next 4 months, that sale will close on the 270 plus or minus lots, and we'll own the land completely free and clear. to speak to the value, if we could sell 270 lots before we built any houses that we're going to do some build for rent for cash flow, before we build the apartments and retail, we would have paid off 100% of our infrastructure costs and own the land completely free and clear, which would allow us then to put the land up as collateral to start building all the projects to further increase our value. So that was a very fortuitous moment for us. It shows that we are not only on track, but we believe that because we have this construction underway when others are halted, the average price that we had underwritten to be able to sell those houses, we believe will be substantially higher because we're going to be the only show in town. At the moment, we have at Rastegar as a whole over 1 million square feet under construction at this moment that's completing over the next 30 to 60 days. Industrial, 600,000 square feet of industrial next to the Tesla Gigafactory. And there's a theme here that I want to point out, which dovetails into the next discussion, is the Gigafactory. We bought the 50-acre lot, and then, thanking my lucky star, Tesla moved their Gigafactory across the street. We started building that, and our investor in that deal is the owner of the Miami Dolphins, Mr. Stephen Ross, who's the CEO of one of the largest real estate companies in the world called Related Group. You might have known the name from them building Hudson Yards after all the kind of debacle we saw there in New York City to build this site. It's almost completing. We've already started to lease. Some of the tenants have already started to move in. Yesterday, we were doing the beam signing of our office building in downtown, and I know that sounds, from reading the headlines, not too attractive, but not many people are building office, and there's still companies moving to Austin. So the leasing activity that we have has also been tremendous, in addition to 106 condos on South First that are all completely sold out as well. I tell you all that because watching different asset classes within the markets that you invest in explain to you what human behavior is, so to speak. So if you look at I-35, you take a tollway called 130 that goes like this. It starts up and around Round Rock, where a little company called Dell Technologies, we might have heard of, is at. It skews around and it ends about 5 miles north of where our Kyle site is. That's the industrial backbone of what Austin is. That's where our 600,000 square feet of industrial is, and where a lot of the higher paid kind of working class part of Austin will be, meaning where do they live? And so I kept thinking, okay, if we're building all this industrial, there's millions of square feet going there, they can't live in Austin. But if you look at where it ends right in Kyle, where houses are still affordable. Nobody else is building houses, as we said, which has gained a lot of interest, not only from the national builders, but we believe will be for future homeowners. All of these things have had a catalyst in some other major corporation that is bringing the people to create the value. So it's easy to look at a project and say, well, we're going to do this, that, and the other, and it's going to be worth more. Or we're going to hike rents. Well, that's nice and all, but when there's true demand and companies like Oracle move their global headquarters, Apple has their second largest office in America, Tesla, who the chairman of Tesla's Larry Ellison, the founder of Oracle, moves their global headquarters, Google's second largest office in the world, is all within this little corridor. And we're starting to see what I've been calling the Californization of Texas. So as we look to this, these prices beginning to soar, there'll be a place where, for us, the pricing is a little bit too high, but we're right there in that spot. And I'm not a market timer per se. I very much, as I said, look at jobs, look at major companies. So when there's a major company shift, we need to pay attention, because when little companies like the San Franciscos that are full of startups, you see what happens when the startups go. Flies up high, crashes down quick. But Oracle doesn't exactly look at things on a shorter timeline. So when Oracle comes, or one of the major institutions like Goldman Sachs, we need to watch, because those are the moments that we believe that massive value creation can happen sheerly by the momentum of what's happening. And that's exactly what's happening in Dallas, Texas at the moment. Top of the headlines today, Dallas Morning News, and they've been whispering about it for a while, that Goldman Sachs is moving their global headquarters to Uptown, which is across from American Airlines, close to the Ritz-Carlton, and also effectively across the street from 1899 McKinney, a site that we bought about 5 years ago and went through a zoning process to get the largest upzone in the history of Dallas, Texas, to be fully permitted and zoned. Well, we had looked to build that building 3 or 4 different times, and I think the vision that I had for it was a little more expensive than the bank wanted to approve at the time. We wanted to build one of the largest green walls in North America. The curvature of the building looks like a tree, because I think the area has become a concrete jungle. And growing up in Dallas, last thing I wanted was Dallas to turn into Houston. And we don't usually say the H word in my office for a variety of reasons. But now that Goldman has decided they're bringing 4,000 to 5,000, think about that number, 4,000 to 5,000 mandatory in-office employees across the street, and there hasn't been new residential development in almost 25 years. So you're talking about a demographic of people. When David Solomon, the CEO of Goldman Sachs, was in Austin, I met with him down on Rainey Street. Ted Cruz's wife, Heidi Cruz, that runs their entire wealth management division, has been a friend for many years. We went down and talked about it, and they kind of, chuckled that we keep going to our site and we just keep seeing a Rastegar sign everywhere. Who the heck is this guy? Ross Perot, the Hunt family, and Goldman Sachs broke ground officially on their Goldman Sachs headquarters. We do a little bit of history, and we're big believers that people aren't as interesting as we think we are, that the tendencies not only of the markets and of human behavior, as Mark Twain would say, history doesn't repeat itself, but it sure does rhyme. And this is one of those moments where we know, I'm one of the guys that I think still reads stuff maybe a little bit more. My wife will tell you that I still read the pamphlets in the airports, or just standing around. But Goldman Sachs has a mandate, and they have for 30 years, to have their employees live close to the office. So you go back to 2001, Lloyd Blankfein made a very, very bold decision to move Goldman Sachs' headquarters to Battery Park in New York City. So Battery Park is in the southern part of Manhattan. Many would call it Siberia. I lived in New York for many years, as some of you know, and the decision was to say that what was happening at Ground Zero, for them to make that move was very bold. Well, you fast forward over the last 20 years, they built housing upon housing upon housing around that Goldman Sachs campus. And the metric growth of the rents of the housing within that corridor around Goldman Sachs's headquarters has been some of the largest metric growth, not the highest dollar amount, but the growth rate that we saw from what the housing was at Battery Park to where it is today is astounding. We believe that same catalyst is going to occur in Uptown Dallas. And McKinney Avenue is that main corridor of the city. A lot of y'all know who've been to Dallas. Clyde-Warren Park is across the street. And so one of the parts of our zoning that in hindsight I probably would have done it differently is to get the height, to get to 315 feet of height. Mind you, the existing building there, and I spoke about this I think a little bit at the conference, used to be an old nightclub. The height was about 70 feet. Now we can go to 300. And one of the givebacks to the council, because going there for zoning changes and things is always a little bit of horse trading, got to go over there and do the dog and pony show, which is fine. In exchange for the height, we gave them subterranean parking, which means that you park underground, which makes the building very beautiful. There is ways to beautify those above grade parking and this, that, or the other, but a below grade parking really makes something beautiful. And at the time when interest rates were effectively at zero and the cost of steel was still at a level that didn't border insanity, on one of our sites, actually both of our sites, the industrial site and the office building, we pre-ordered the steel because of so many logistical problems with getting in. It turned out to be quite the blessing, painful on the front end, like most things are, but has worked out. We want to go back to the city and say, look, this particular site is one of the last pieces of development potentials in the entire uptown area, unless you start bulldozing real big old buildings, which Dallas by 2035 is projected to be the most populated city in the United States of America. Yeah, Goldman talking about, building the new $500 million campus, which is the top of the news today. The average income of those folks is $500,000 a year. Dallas doesn't have that kind of money. $500,000 average for a bunch of New Yorkers coming over. I've been there. I've seen both sides. I was born and raised in Texas. I lived in New York for many years. Those folks are in for a shell shock. So keeping up with the Joneses and wanted the fancy condos and apartments, and they got to stay true to the mandate to have walking distance, to their office. Therein lies the opportunity. So to make costs work more, and the purpose of this discussion, why the timing is so critical, is Dallas has been flooded with zoning variance changes for the past 10 years because rates are low and money's flowing, which makes the council a little bit more picky of what they're allowing. So one of my dear friends, Miss Sarah Dodd, who's been our consultant for many, many years in Dallas, she got us through the zoning council process, which took about 9 months. I took almost 200 meetings myself to get that first zoning, to meet the condo owners, the business owners. And I know it sounds a little crazy. I've done worse. But I got to know those people really well and understood what their needs are, what they're looking for, and real zoning changes that aren't just about profiteering, which profit isn't a bad word in my office, but how you make money matters. And we know from talking to the people, not the council, that they want to see something on this site. They're done seeing what they call the missing tooth of uptown. You have all these big old buildings here, then you got this chipped tooth right in the middle, and they're wanting to see that void filled. And they're uncomfortable a little bit about what's going on with, the Goldman Sachses and the movements, and they want to know who's going to be the custodian of the community. Who's going to build the things that the city needs, make some money in the process, fine, but make money because they built the right thing. So Sarah's husband, who passed away recently, was the chief of police of Dallas. And she kind of informed me that the dockets have been a little bit light on the council. So when you look at the cycles of real estate, which it is very much a cycle. So when those good years, I tell my team all the time, when the money's flowing in those good years, you got to average out those profits against the years when it's going to be a little lower, just to make sure you have a good grip on what kind of money you're actually making, because it's very easy when you see that start coming to drink the Kool-Aid and not remain disciplined. So since the docket is light, since we know that we have the people, we're going to go ask them for above grade parking and say, okay, I'm not going to be able to build the living wall like I like to. I'm going to take the hickey. The building might not be as curvy as I'd like, but we've sketched some beautiful, beautiful designs that is exactly what that corridor needs in response to the people we've spoken with. And by eliminating subterranean parking, the cost basis drops dramatically. We've joked in-house that we're basically building a parking garage that happens to have a building on top of it because first of all, the site's a triangle, which makes it a pain. It's about half an acre, which in New York, that's 50 acres maybe. So and it has a 15-foot slope, from the way McKinney Avenue goes down. But it's at the only four-road intersection of the city of Dallas. You have Cedar Springs, McKinney, North St. Paul, and Ackerd all converging. Salesforce, largest lease they've signed in America outside of San Francisco across the street. All the macro is set up to go through the planning and get what we call a variance against the existing zoning. All that costs money. The new architecture plans cost money. The consultants cost money. If we get this right, which I'm sure it'll be a little delayed and there'll be little snafus that pop up like they always do, we can go in over the next 4 months, confirm above grade parking, finalize our new plans. And the good part is we spent a bunch of money already on the designing and on the massing, so we understand what we're working with. And be in a position with either HUD financing to do the construction with a couple capital partners that we've spoken with that are willing and eager to even do some of this all cash and refinance later once interest rates are a little bit more accretive, which based upon the inflation, because we believe some of the inflation numbers that we're making decisions on are a little delayed, because the consumer price index, which shows inflation, about 70% of it plus or minus is rent and housing. And so those prices that we're seeing across our multifamily portfolios have begun to descend. And so we believe that inflation is, whether it's a little bit above 3%, I think the last report we read, it was about 3.7%. We would argue that it's sub 3, but we're kind of splitting hairs, is that we go in, we make these changes, we start construction on this building in less than a year. 3 years from now, we will own what we believe will be the postcard for the city of Dallas for the next 50 years. So not only is there a tremendous value creation potential, but it's also the right thing to do. And so I've kind of gone out of my way a little bit to talk to our existing investors, friends, family. My college roommate, for goodness sake, I'm having him put $50,000 in the deal, because they don't always come along like this. Deals are like buses, as we all know, right? They come and go. They say this is the best deal in the history of whatever. Someone's selling you something, but this one, like Kyle, for a different reason. And when I look at the way y'all have invested with us, we believe it's a great diversification point, because one is the epicenter of a major city. It's the central business district. The other one is the 15-mile outer district of the city of Austin. So they're very different strategies, but at the core, they're the same. They're catalysts that are filling a need of a major company relocation, so to speak, that the demand is unbelievable. So we would like to allow all of our existing clients across the pensions, from the, as you all know, we have a very diverse group, from athletes to lawyers, doctors, you name it, to come in and be a part of it. So it's something that we can enjoy the process as well. I'm a little bit cheesy like that. It was my daughter's four-year-old birthday yesterday, and we had the beam signing on our East 8th downtown development, and I was a mess, obviously, and signing the beams and looking at all this stuff for a poor kid like me delivering pizzas and flipping burgers, not that long ago. This is, this is a very special time in my career, and to be able to be doing some of this stuff when we're seeing the rest of the industry really take a beating. And we have too, to be honest. A lot of our, some of the multifamily projects, the rates have gone up a little bit on some of the construction. Some of the rates have gone up, so you're drinking your own blood on a little bit of this stuff. But when you weigh the whole thing as a portfolio, we're very proud of the work that we've done, certainly for the pensions and for other groups. And I'd very much like for you all to be involved in this one with us for a variety of reasons. A lot of the smaller pensions, like smaller investors, don't get involved in the Kyle projects of the world or the 1899 McKinney projects of the world. And guess what? Neither would a kid like me, but we got lucky enough to have it, and we're going to see it all the way through. And And so we're going to raise the initial capital to go through all the rezoning, all the plans, have enough equity to get ready for construction, but wait for rates and things to be, to be accretive, or like I said, go with a capital partner that would like to do it all cash. The opportunities are all around. We've been hearing whispers for months about the Goldman folks wanting to buy our site, and since it's already zoned, and I like to look at things in terms of if everything goes wrong, what would we do? The land, as is worth significantly more than we paid for it. So if, God forbid, all the grandiose plans I have and the zoning doesn't work and this doesn't happen and that doesn't happen and rates stay high and the world goes to hell in a handbasket, we could sell the site and still make upwards of a 27% return. Mind you, I went through 5 years to create that. So that wasn't overnight, and we did a zoning already. So I believe it has what jargony you would call a great risk-adjusted return, because if we're right, we don't know what the price per foot could be on the condo side or the rental, because we've never had in Dallas 4,000 people making $500,000 plus a year living across the street. So I would normally not look at those things and say, oh, it's unlimited how much you can make. If we built them today on a price per foot on a condo basis, the market stands, we make substantial returns. We'd be comfortable. But if these folks come in and the exuberance drives up the market, and we're able to capture that, something really unique could happen that I'm not going to put in a spreadsheet. I'm not going to put in an investment package. But that is a stark reality to this project. So I spoke about this at the conference briefly. I know some folks were interested to hear about it. I wanted to come myself to share with you, and between this and Kyle, this is the most money me or my family have ever invested in any 2 deals in my entire career. So we're in, and we would love to have y'all be a part of this with us, be at the groundbreakings, and a project like this we take our grandkids to, and hopefully we build something that outlasts the work that we're doing today. So if you have any questions or thoughts, I'd be more than happy to answer them or give you any clarity if you need. The investment packages and all the particulars have been explained in detail with your consultant. They have all the stuff. Will is very informed about all of these already, and I appreciate giving me the opportunity to come, say it myself.
Any questions from the board? I have a couple, actually. What if the rezoning to eliminate the subterranean parking is denied? I know that by itself wouldn't be a deal killer, but what would theoretically be the plan if that is not something we could renegotiate?
It's actually the thing that keeps me up at night. I appreciate the question. It would just make it more expensive. So with our zoning and our entitlement now, we have plenty of debt indications that the deal pencils. But with rates where they are, you need to be as cautious as possible. So it's not by any stretch of the imagination a deal killer, as you said. But when you have subterranean parking, we estimate that the total cost of the project would be around $9.5 million more. So when you take $9.5 million times 8 or 9% debt over the course of 2-3 years until you finance, that number starts to add up on a total cost project, which is around $100 million. So we can get there, but I figure when we're in this lull and rates are high and they're not busy, what do I got to lose? Yes, it's gonna. Well, I shouldn't say that. We have money and time to lose, but the amount of money we believe far exceeds the risk capital that it would take to get there, which would just make it that much easier for us to be able to pencil, and we see it as found money. And so if we don't, we're still building the damn building.
All right. Second question, and Will, you might have this answer. With the horizontal infrastructure in place in the Kyle property, what has that done in way of value to the capital basically that we have on that property in the way of what we would look at as a potential return to the pension fund on that initial investment.
Fantastic.
I would defer to Ari and Charles on that, but my assumption is that obviously there's a higher value now
Yeah.
than there was before because of that infrastructure. However, I don't think we have a more recent valuation than we do that reflects the cost basis of the pension fund's investment.
That's exactly the right way to put it. Doing these other new valuations, so to speak, once the road is done over that next 4 to 5 months, the bank will necessitate some sort of new appraisal or some sorts. But without having my compliance or audit team kill me, it's a lot more. Yeah, a lot.
What he's looking for is every year, at our year end, we have to value our financials, and we're looking to bump that up. To have some kind of paperwork that says this is what this is worth. And so we
Yes,
can
ma'am.
bump it
I
up.
can absolutely do that for you because we had an updated appraisal done to get the horizontal land loan. And again, mind you, it's a few months in the past, but the last number that I looked at, the value of the land since purchase is up at least 300% since purchase. But there's also a lot of cost that goes into that. There's additional debt, so that's not a number, but the value creation on a land basis in a vacuum has increased far, far greater than we underwrote, so to speak. And I believe that Will can speak with our auditors and our third-party admin and be able to provide that for your files or something to show you from a third-party perspective that the value has, in fact, gone up tremendously.
Any other questions? Nope. All right. Ari, I appreciate you making the long drive up here. I appreciate your presentation, and we will meet with Will. You're welcome to stay for the remainder of the meeting, or if you need to head southerly direction, I completely understand. I know it's a pretty good travel home.
Absolutely. Will, whatever would you like me to stay a little bit, or your call, sir? I think we got muted.
Try again, Will.
I know what kind of drive that is. Personally, I'm going to cut you loose.
Thank you. Okay. I appreciate it. I'll take the pass. It was great seeing all of you all, and I look forward to talking more about all this.
All right. All right, Major, great to see you both. Safe travels home. All right. Moving on to presentation A, presentation of our third quarter pension performance. We'll turn it over to Will Harrell.
Yes, sir. Well, good morning, everyone. Thank you, Mr. Chairman. Let me start with the commentary from Q3. Can you hear me? Can you hear me all right, Mr. Chairman?
Yes, sir.
Okay, great. And you can see my screen?
Yes, sir, and then we have a printed copy of both.
Okay, great. All right, we'll jump right into the market commentary for Q3. After gaining nearly 17% for the first half of 23, the S&P was down 3.27% in the third quarter. S&P has drifted below. Actually, when I wrote this, the S&P had drifted below bull market status. So this was written in the latter part of October, and October had quite the sell-off, and then November has had quite the rally. So it had drifted below bull market status, having only risen 17.7% at the time of this writing from October 11th. At the moment, from October 11th of 22, the S&P is now up 27%. So that is really, much of that is the November rally. And you may have heard this Magnificent Seven. This rally is very concentrated amongst a small group of stocks. So if you aggregate the top 7 stocks that have been pushing the market north, they've gone up 72% year to date. And if you look at the other 493 stocks in the S&P 500, theoretically, they're up 6% year to date. So this rally is being driven by just a handful of stocks. And of course, so we are back in at 27% up over that recent low. We are indeed up over that 20%. We are back in a bull market. As of 9:30, the total return for the S&P was 21% for the trailing year, 10% per year for the last 3 years. That would include COVID, and 22 when the market was off 18.55%, 9.92% per year for the last 5 years. So even through COVID, even through the interest rates going up 450 basis points, the S&P, as Warren Buffett would tell you, is the best game in town. Stocks in the large cap Russell 1000 were down an average of roughly 9% from the stock market's 23 high on July 31st through the close of the third quarter. And after finishing 22 down 13%, the worst year for bonds on record, the bond index was down at the time of this writing. The bond index was down 1.21%. And that was because towards the end of October, the belief was we still had some rate hikes ahead of us. Those rate hikes have not materialized. Because they have not materialized, the bond market has really rallied since October 23 of this year. So 1 month ago, the bond market has rallied over 4% in 1 month, which is, and I've said this, I think, in a few of the prior meetings, but with a 13% down last year for bonds, as soon as the investing public gets even a whiff that the plateau of rate hikes has arrived or potentially a pivot, people are going to be out in the streets fist fighting each other for bonds. I mean, bonds are going to be the greatest thing in the world because people are going to look around and say, wait, I can't get this 5% treasury next quarter because obviously they could pivot and go down. So the appetite for those bonds has increased dramatically, 4% in this last month. And we've seen the treasury yield on the 10-year go from 5% down to 4.4% as of today, which again just simply means that people are buying them. The price of those bonds is going up and the yield on those bonds is going down because the interest payment on those bonds is fixed. And again, this is that 10-year treasury number is old news, but it was 3.81 at the end of the third quarter. I'm sorry, in the end of the second quarter at 3.81, in the third quarter at 4.6. So into the second quarter, that 10-year had really dropped, but then it bounced back up. According to Redfin analysis, home buyer must earn $114,000 a year to afford the median priced U.S. home, which is $40,000 more in income than the 22 median household income of $75,000. And 38% of home buyers under the age of 30 needed money from family to afford the down payment. Despite volatile markets and sharp declines in fixed income, state and local pension plans in the United States are 78% funded for 2023 based on plan projections. That would represent a post-financial crisis high and compares to 76.2% funded in 22, 72.9% funded in 2019 prior to the onset of COVID. American support of labor unions has steadily been increasing since the financial crisis. Support for labor unions hit a record low of 48% in 2009, but steadily increased in the years that follow, hitting a 50-plus year high of 71% last year. Now, union support did dip to 67% this year, primarily due to the strikes, the UAW strike, the Teamsters strike, the Writers Guild strike, and others. It did dip this last year to 67, but it's still above its long-term average of 62. And then real GDP grew by 4.9% in the third quarter, driven really by strong consumer spending and a lot of government spending. Think the infrastructure bill. A long-term average is 3.18, so that 4.9 is way above the average. And that plus the unemployment rate at 3.8% through October really is what panicked people to thinking that interest rates were not done rising. But we just haven't seen that materialize just yet. Clients fully invested, diversified, rebalanced diligently. As a reminder, this portfolio will be rebalanced back to a zero tolerance and in about 1 month. That happens in the middle of June and the middle of December every year, dispassionately. S&P was down 3% for the third quarter and up 21% for the trailing year. The bond index was down 3% for the third quarter and flat for the trailing year. International stocks down 4% for the quarter, up 26% for the trailing year. Emerging markets down 2.79% for the quarter and 12% for the trailing year. And the TIPS index down 2.6 for the quarter and up 1.25% for the trailing year. And oil closed the quarter at $90 a barrel on the New York Mercantile Exchange, up 12% from $79 at the end of 22. However, it has backed off to, I think, roughly call it $83 a barrel. So we've seen that relief at the pump. That is not because we're producing more. That is a lack of demand. And this conflict in the Middle East between Hamas and Israel has yet to really bleed over into a petroleum or oil producing nation. Think Iran. But the moment it does, and Israel, for whatever reason, begins to bomb those depots on the Iranian coast, there will be a major shock to the system if and only if that happens. If there are no questions on the commentary, I'll jump right into the report. Let me blow this up a little bit. If for not your eyes, then for mine. Sir?
I was just asking if there was any questions, and there was none, so continue, please, sir.
Okay, sorry, Colby, I can't see y'all with this sharing the screen, so I'm sorry. Okay, gotcha. So all the information in this report is as of September 30. I do have an update through last Friday as well. So as of September 30, the total portfolio value is $87,051,992. As of last Friday, the portfolio had risen to $87,970,281. So that's up about 1.03% since the end of the quarter, and that's not being adjusted for capital flows in or out. Running currently at about a 63%, 62% equity funds, 2.5% hedge funds. There's your Kyle project right there, your 2%, your other real estate exposure there for a grand total of 4.8%. Cohesive Capital, PIMCO Bravo Fund, these are just smidgens at this point, 1.46%. Then our fixed income composite is composed of Guggenheim, PGIM, Blackstone Breads, which has really gotten teeny tiny over the years as we've gotten out of it. JP Morgan Global Opportunities, BlackRock High Yield, and MetWest Floating Rate Fund for the total fixed income of 33%. And then this smidgen of cash here at $608,000. Now this is as of Friday, and while we're on the topic, well, Pam's not here at the moment, and we've been volleying some emails back and forth on some upcoming drops and cash flow needs. Therefore, Charles and I are planning on raising money here in the not so distant future. Charles, do you have those numbers?
Yes, I believe we're going to raise around 500,000. I don't believe there are any drops, but it's just for payroll on the first. We want to make sure we clear that, and I don't believe there's nothing in the actual account now to cover it, so we're going to do that before the first.
That's right. That's right. I remember now. They're not drops because of the contribution change. Exactly. So currently running at $87,970,281. This page is a graphic representation of the prior page. I would simply comment that it's a highly diversified portfolio, incorporating both active institutional funds and also index funds to keep the cost down and gain that exposure. Diamond Hill is a fund that we will be asking to replace today. It's been on the watch list for a couple of 2 or 3 quarters now due to its exposure to commercial real estate, including Silicon Valley Bank, Republic, and United. Hood River Small Cap Growth is a new addition, replacing JP Morgan recently. There's your iShares Core US REIT. There's Kyle, your international funds, your emerging market. Fidelity is also a new fund, replacing, I believe, T. Rowe Price Emerging Markets Funds. Millennium, Cohesive Capital, all the way around to your fixed income instruments, to your cash. It's your asset allocation by asset class: 43% domestic equity, 8% international equity. So not too much. Like a lot of the bigger plans have huge slugs to international. 5% real estate, 5% emerging markets, and then 33% fixed income. Of course, these are all rounded up. I just mentioned your 4.8 on your real estate. 5% alternatives, and 1% cash. Starting back in 2011, this is your unit value schedule. You have a target rate of return of the portfolio of 7%. You have an inflation assumption embedded in that actuarial target rate of return of 3%. So your real net goal is 4%. Just running through the years here, 2015 off 6%. And I would just point your attention to the CPI number. 73.1922, very tame. 73.1922, 22.12, and then we get into, here's your pandemic quarter. There's how you pulled out of 2020 with an 11.5% rate of return. 2021, 11.2%. Inflation took over half of that, leaving you with a 4% actuarial contribution. 22, you see we were extraordinarily fortunate, down 15% when we began to deploy the $46 million pension obligation bond money, with another 6.5% inflation for a negative 20, but most of that negative 20 took place before we began investing the pension bond money, the pension obligation bond money. You can see these outflows are a consequence of the new funding arrangement with the city. Portfolio is up 4.38% in the first quarter, 3.54% in the second quarter, down 3.27% in the third quarter. And you can see how CPI is beginning to fall off a little bit. There's 2.8, 3.6. I believe we're running at 3.2 or 3.7 right about now on a trailing 1 year. I think it's 3.7. So your cash flows over that 12.75 year period, you've added $21.2 million. Over that same period, you have a 4% growth rate, 2.6% inflation, which is a 1.2% real. And if we were to just back up to 2020 before inflation began eroding all this, we were much, much closer to your 4% real target. But this 21 blip of inflation in 22, hopefully those inflation numbers will come down, allowing the nominal performance to really contribute to the actuarial requirements of the investment portfolio to get this 1.2 number, again, climbing back towards 4% where it belongs. Looking at the total fund on the executive summary, you can see from above, as they say, on a 5-year basis, 3.92%, outperforming 2/3 of the managers in that peer group. 4.28% over the trailing 3 years. Of course, that includes the pandemic, outperforming 86% of your peers in that peer group. And over the 1 year, September 30 to 22 through September of 23, up 10.87%. That's net of all your fees. Again, beating 2/3 of your analytic peer group, as we would call it, over that 1 year period. Looking at the individual managers, Loomis Sales, top quartile, which is really something considering most of those large cap growth funds got killed in 21 when tech began to sell off after the pandemic. There are a lot of T. Rowe Price funds that got absolutely hammered over that period, and Loomis Sales did a great job. Large cap value, top third. ClearBridge is a relatively new replacement. You may recall last quarter, they dipped a little bit on the front end or on the short end, but they've come back to nearly top quartile, or not top decile. Diamond Hill is a fund we'd like to replace today, down in the 71st, 93rd, and 97th. Hood River is is that new replacement 12th. MFS Discovery 64th. Vanguard International, a very volatile asset category, but first on the 5 years. So this 79th doesn't give us too much indigestion just yet. Vanguard International Value top third, dips in the 60s. Fidelity Emerging Markets is your new emerging markets fund that replaced T. Rowe Price Institutional Emerging Markets Fund. BlackRock top quartile, and MetWest. And I say this, I think, every time we get together recently because it just pops in my mind. But at some point, Charles and I are going to have to bang our heads together and find out or figure out what to do with this floating rate position, because the utility of having exposed the money to floating rate is really garnered primarily during rising interest rate periods. And when we reach finally at some point, I'm not predicting when, an interest rate environment where rates are dropping precipitously, we'll have to really rethink the utility of this particular fund. But of course, it's done a fantastic job throughout all the turmoil of 2022, particularly with the fixed income market being off 13% and the floating rate bonds were off, I believe, 6 to 7%. So they were a great buffer during that period. Now looking at return and rank, these are going to be the managers that are either index funds not designed to produce a value add, i.e. alpha, or hedge funds and bond funds that really don't have a high enough R squared or a fit to a given benchmark. They're just nothing like the benchmark. Therefore, making some sort of risk adjustment is a fool's errand. So we just put them into return and rank. Vanguard Large Cap Index Fund, 42nd, 31st for Mid Cap Growth, 85th for the Mid Cap Core. This little phenomenon is still happening amongst small cap and mid cap core. Charles and I have had major debates over what to do here, and we just are convinced that if we do a search for small cap core right now, we're going to land at a manager that will ultimately fail, because small cap core's long history is one of index funds have typically been better, but time will tell. And if we need to make a change, we're happy to. Real estate, top decile, Guggenheim, top third, bookended by a 39th and 9th. PGIM, top third, JP Morgan Global Bonds, second, first, and 30th. Millennium, first, second, and seventh. That's the only hedge fund that was kept between Millennium and Balyasny. I think that was a great decision in hindsight. Blackstone Breads down 16.45% for the year. Cohesive Capital, 19%, up 41% on a 3-year basis. I would defer any questions to my counterpart, Charles Smith, on the performance. PIMCO Bravo Fund, -11, -13, and -44%. Of course, it only represents a tiny fraction of the fund, but $77,000 or $78,000 is $78,000, and we are getting out of it as quickly as we can. And then the student housing up 11.6, 14%, and just 1.6% for that trailing 1-year period. The return, this will be just about my final exhibit, and I'll jump to the replacement for Diamond Hill. This is Longview's total fund return versus their very custom granular benchmark. If we just pop back to 10 years, 3.9 to 4.63. So clearly some underperformance, even though there is about 80 basis points worth of cost to run the pension fund that is not in this number here. So 4.6 versus a 3.9, but then you see the tables turn 5 years ago. I guess that'd be about 2018. Well, I guess we were hired in the end of 2017, and the portfolio had a major facelift at the beginning of 2018 or the end of 2017, if my memory serves me.
I think it took you almost 2 quarters to get fully invested due to the transition in 18.
Got you. And, oh, yes, that's right, Colby, because of the drag from getting the assets from Morgan Stanley. Yes, it's all coming back to me. So the trailing 5-year, 3.92% versus a 3.71. 4 years is a 3.9 versus a 3.71. 3 years 4.28 versus a 2.4, and that's that pandemic time cut. The 2 years, which includes obviously last year, down 4.16, the benchmark down 4.51. 1 year up 10.8 versus the benchmark 10.2, and year to date you're up 4.5. Well, actually you're up 5.5 because of that 1% off the end of the quarter. Well, let me just keep it apples to apples. 4.5% through the end of the third quarter, and 3.8% for your benchmark. I guess my point in bringing this up is that ever since everything got flipped around and surgery was completed, y'all have had consistent outperformance against your custom benchmark, and in the public pension world, that is completely unheard of. And it's not magic. It's simply a function of maintaining managers that are above their respective benchmarks, and that way, when Charles builds the custom benchmark using their benchmarks, obviously you outperform. It to what degree changes clearly, but that outperformance is really something to be very proud of as the decision makers for the fund over this trailing 5-year period, including that consultant hire. I cannot pat you on the back enough for that one. And then the return rank I'll leave you with. So 10 years, y'all were ranking 72nd percent. And Colby, you guys remember it was 90th across the board. Now you're top third, nearly top decile over a very rough 3 years, top half, or rather right in the middle for the 2. And you can see that dip right here. And then the 1 year up top third, and then year to date, the top third. So again, these are just really fantastic numbers for a public pension fund, and something that will keep you out of the spotlight, I believe, for some time to come.
Where we love
Now,
to be, not in.
Yes, sir. Understood. Now, on to the Diamond Hill replacement. Now, as I mentioned, Diamond Hill's regional bank exposure really bit them when the commercial real estate epidemic began. There's still about $1.6 trillion of refinancing to be had amongst commercial real estate. You heard Ari sort of allude to it. Well, that's what we're trying to avoid by making this change. And so we are going with a very well-known, actually, it's funny. We do these, every time there's a search to be had, we do these searches completely blind, and ever so often, a fund that we own or a fund that one of our clients owns elsewhere will pop up on a brand new search. And the reason for that is because of consistent outperformance. And this is actually, and I've told y'all a million times, we don't have a stable of managers and an approved list, but this is actually a fund that we've been using with other clients for years and has done very, very well for them. It's called the Fidelity Low Price Stock Fund. It is a Fidelity fund, but they're a little unconventional the way they choose stocks. They look for stocks that they believe they have a thesis that many stocks that are under $35 are mispriced. And so they're looking at not only that mispricing of these particular stocks, and you can see their performance here. When the mid-cap value is down 2%, they're 0, 3.8, -1, 12 versus 11.7, 8.464, 7.565. And for the life of the fund, it's pretty old funds. I believe it was, when was the, I'll see it down here in a second. Calendar year returns for 2020. So pandemic year, they were up 9.3%. Even in a very rough year when the S&P was off 18.5%, they were off 5.8. Mid-cap value index was off 8% for that year. You can see here they're 94% or 96% of their assets covered. They're very much staunchly mid-value. They do have a little international exposure, which we do not mind. You'll see that the financials are now much lower on the sector exposures than they are for Diamond Hill. We also had another manager we were looking at, but they had a lot of energy and financial exposure. Even though they'd done very well and weren't exposed to as many regional banks, we just thought it best to go with a fund that's more diversified and a little more conservative. Expense ratios, 92 basis points. Of course, I think our report's far more interesting here. Let me pop this up so everybody can get a look at it. So you're always hearing about northwestern quadrant. Well, as far as the average in this peer group for return and risk, there's the mid-cap value benchmark right here, that diamond. Diamond Hill is here in the southeastern quadrant, and Fidelity finds itself in the northwestern quadrant among some of the very top mid-cap value managers in the space. And all these little bitty dots are all the managers theoretically in that space. And there are about year to date, there are about 140 managers in that space right there. So Fidelity Low Price Stock Fund, Diamond Hill, and then the benchmark itself. This goes from 2012 to 2023. So this is 11 years, 10.4 to an 8.9 to a 9.6, 14.3% on the standard deviation. So higher return, lower risk than both the benchmark and Diamond Hill. The downside risk is lower. That's a function of this lower beta that they maintain. So they're really managing risk. And in mid-cap value, that's what we want. We want them to be managing risk. That's where you get a lot of your fuel. That alpha number, that's 2.12% per year, every year for the last 11 years. That basically means that they produce 2.12% in performance that cannot be attributed to anything but their ability or their skill in selecting stocks. Sharp ratio is significantly higher than either Diamond Hill or the benchmark. And then the tracking error is not too high. The tracking error is the standard deviation or the risk or the reliability of the excess return. So you want this number to be low. And because there's no excess return to a benchmark, it's zero. From a style standpoint, here's your benchmark and here's Fidelity. Diamond Hill is really meandered quite a bit off of that mark. This is just the return. This is the return going back 30 years on the Fidelity Fund and going back 10 years on Diamond Hill. And then, of course, the benchmark definitely goes back 30 years. And then the median manager here. Return rank, I think we're starting to hone in on what we're really more interested in. 0, 5th, 2nd, 4th, 11th, 14th, 48th, 17th, 6th, and 12th. Just a really nice, consistent, yes, a little dip here among the 3-year, but nothing that gives us really any qualms about having this manager employed. And then the alpha production, you can just simply see this is positive. That's what you're looking for, just positive alpha production. And Diamond Hill has done so much damage in the near term that their historic alpha production is now negative. And of course, the benchmark does not produce alpha. And now my favorite metric of all, we see the alpha rank. So this sort of takes in everything. And look, so over 30, 25 years, 20 years, they were the very top manager on a risk-adjusted basis. 10th, about 10th, 32nd, 33rd. So there's that little bit of dip, but the dip is not nearly as, you don't see the dip as much. You see it more here on the return rank, but once you adjust it for their risk, that they're not taking very much risk, the alpha rank looks even better. So 32nd, 33rd, 20th, and 45th year to date, which is short-term stuff. But at any rate, Mr. Chairman, this is a fund that we think would be a great replacement for Diamond Hill, and we believe it would serve the pension fund very well moving forward. We'd like the approval to make this change, and we would effect that change ASAP.
Any questions for Will? No? 2 questions from me. One, the small cap core that you said there had been discussions about going to active management possibly. Mm-hmm. What is the difference return rank or return wise between you know, the top percentile and I mean, would a fee of active management even cover what the difference between passive management is right now versus active management?
Well, and you just hit the nail on the head. Let me find it for you right quick. I can pull that up. Best discovery. What's the 2000? Charles, what page is that on? Oh, return rank. I'm almost there. Okay, Doug. Let me go ahead and share my screen. Forgot to do that before I started looking. All right, let me blow this up. This will be found on page 29 of your report. And so when we're looking at this ETF and saying, well, you know, it's at the bottom of the peer group, that's really because the Russell 2000 itself, you just have, at the moment, you have a lot of managers that are outperforming that particular, you have active managers that are outperforming that passive investment. So when you look at it against the benchmark, you see that it's right in line with the benchmark. But so what an active manager might produce for you in excess of the what an active manager might produce for you in excess of the passive manager net of their fee is something that Charles and I are looking into.
All right. And then last question, do you have any comments on the presentation from Mr. Rastegar?
Well, I think that Ari has stumbled into a couple, as he mentioned. I mean, this is and I don't think stumbled is probably the right word, but 5 years of working on the piece of property on McKinney. I'm from Dallas. Charles lives in Dallas. We're all familiar with Goldman Sachs. Assuming that everything that he has put forward is accurate vis-a-vis the salaries of these employees, the permit. I know that Goldman Sachs has already offered to buy this piece of land from him on a couple of different occasions. So your current, if it's something, you started with Kyle. Kyle is a multi-faceted development with apartments and residential and a school and a green space, and it's far more diverse. This is more of a rifle shot, obviously, than Kyle was. You are currently at 2.4% real estate. I think if there was enough of an appetite, it's not something that we as consultants are against. We think it's a great opportunity. However, you're beginning to bump up on your real estate allocation. So if there was an appetite, sir.
Real quick, they're right at 5% real estate if you count the REIT.
Got you. So you've bumped up against your real estate, your current real estate allocation. If there was a real fire amongst the board members to participate in the McKinney project, I don't think that there is a big hurdle as far as a minimum investment, but it's something that would really, it just really depends on the appetite of the board. If it's something that the board is interested in, yes, we could make a little room. If it's not, the portfolio is not going to suffer for not having participated in it.
How long is he gonna take investments, did he say? He said he sent all that to you. How long is this gonna be open?
I believe you mean as far as for investment?
Yeah.
I know it'll be open through the very beginning of next year.
And what would the amount be?
Does he have a minimum investment?
He really doesn't. I think what he's looking to do is just simply, I believe that he realized after beginning to partner with public pension plans how good that business is and how good that is for his firm. And I think from a capitalist point of view, he is, as Scott Olguin would say, looking to put as many stickers on the race car as he possibly can. Therefore, I think his minimum investment would probably be somewhere around $100,000.
Any other questions? All right. If not, Will, I appreciate your presentation. If you don't mind holding for 1 second, we'll go ahead and move into our first action item, which would be any motion regarding the recommended trades from the third quarter presentation, performance presentation from RHI.
Motion to approve. Motion to approve.
Second.
To approve the recommendation of Diamond Hill to be replaced by Fidelity Low Price Stock Fund?
Correct.
All right.
Yes.
Yes, all right. Motion and second to approve the trades as recommended by RHI. All in favor say aye.
Aye.
Anyone opposed? Motion carries. Did you hear that, Will?
Yes, sir, and we will get with Pam once the dust settles over at administration to get a really tight handle on the cash that's needed, and we'll raise that sooner than later.
All right. Thank you, sir. We'll move on to item B, review and motion regarding the recommendations from the Kyle project presentation.
So what was clear on that? What's the recommendation?
It was more of a presentation, and let me start off by apologizing. Pam went to the office to forward it and print out all the information that we've had to read on the little screen, and obviously was delayed. That email will be forthcoming as soon as she gets cleared up for review from there. I believe his recommendation was just an offering of the McKinney project, of which we can discuss, we can table to next meeting, or we can say we're not interested in, I guess would basically be the three options.
I'm very interested.
I'm interested, but I would move to table that until we get the information that Pam was gonna give us where we could review it and then maybe talk about it next month.
Will wants to speak.
Go ahead, Will.
Okay. I was just going to make sure that Pam had what y'all needed.
All right. She unfortunately is still at the office with
Understood.
Detectives. Hopefully not in cuffs by this point, but. She texted in cuffs. I'm impressed. All right. So I have a motion to table item B.
Second.
All right. Motion and second.
Wait, who first it?
Maria has graciously stood in as our
Note taker.
note taker for Pam. I got a motion and second to table item B. All in favor say aye.
Aye.
Anyone opposed?
And
All right.
real quick, I'm sorry, Will,
Sure.
I would like to get caught up on the Kyle project as well. So
Sure.
with that information, I would like that as that's part of it to know, what all we did on that, so I can,
You
Oh,
missed the
sure.
last
I can,
presentation of Corpus Christi
I did.
With the drone show and everything.
Oh, well,
It
if I
was-
can get caught
That's
up, that would
probably
help me
why
out.
we're all like, yes, yes, yes.
Well, I want to know what we did on the Kyle
Yeah.
project.
We're not
I mean,
all
for me
yes,
to
yes,
know.
yes.
where
That's an overspeak there.
Where can I email that to?
You can get it to us. I mean, I guess all of us would.
If you'll send it to Pam and just say, if you could forward that to John.
Yes, sir.
And
And
JR.
Oh, and J.R. Parker.
Just have her forward it to all of us. That
There
way
you
it's
go.
just
Yeah.
easy.
Gotcha.
Share all.
Yes, sir. I'll take care of it.
Thank
All
you, Will.
right.
Hey, can you, and ask her to add Logan Letkins to that, because he'll take over in January too. He comes in kind of.
Will do.
All right. Well, I believe that's it for the portion that probably is regarding you. You're welcome to stay for the meeting if you like, but I'm sure you have other things you need to tend to.
I've got about 3 minutes before I've got to get on another meeting.
All right. Well, we timed that perfect. I wish you a happy Thanksgiving to you and your family, sir.
Yes, sir. The same to each and every one of you. And if you need me for anything, please let us know.
Thank you.
Thank you.
Yes, sir. Y'all have a good day.
You too. You too, Charles. All right. Action item C, review and motion regarding the reconciliation for the month of October 2023 for Moody checking account, Moody disbursement, and Morgan Stanley Smith Barney omnibus.
That big check to Edward Jones is the Scott Smith disbursement that we're gonna talk about later. That's the only anything outstanding that I can see. So I move to approve the reconciliation.
Second.
All right, have a motion and a second to approve action item C. Any discussion? If not, all in favor say aye.
Aye.
Anyone oppose? Motion carries. Action item D, review and motion regarding the internal financial statements for October 2023.
If you compare this to December of last year, it's only up $600,000. But if he could give us a number for the cow, that would bump it up more, which would help us, our return.
Yeah, and I think we're at 87.9 as of today.
Yes, that's
Yeah.
right, yes.
On that, which historically, the third quarter, worst performance quarter.
Yes.
I move to approve the financial statements.
Second.
Have a motion and a second to approve the internal financial statements, action item D. Any discussion? If not, all in favor say aye.
Aye.
Anyone opposed? Motion carries. Item E, review and motion regarding the minutes for October 2023 meeting.
Motion to approve the minutes.
Got a motion to approve the minutes. Do I have a second?
Second.
Motion and a second to approve the minutes of the October 2023 meeting. Any discussion? If not, all in favor say aye.
Aye.
Anyone opposed? Motion carries. Action item F, review and motion for the retirement and drop of Scott M. Smith. Should be under benefit requests.
Did you work that one, Colby?
Having approved this, I will make the motion to approve the retirement of drop
I'll second it.
of Scott Smith. I did verify all those numbers were correct.
I'll second that motion.
All right, any discussion? If not, I have a motion and a second to approve the retirement and drop of Scott Smith. All in favor say aye.
Aye.
Anyone opposed? Motion carries. Review and motion regarding Plant Administrator annual bonus per policy. I believe the policy stated that, I know last year we approved a bonus equal to 2 weeks worth of her salary, as long as she had a positive performance for the year, which I would say she absolutely did. She's probably a little stressed out this morning, but Pam has actually done an amazing job of keeping the fund in good order and accounting and staying on top of our vendors to make sure that they're getting everything done and our reporting is in line with all the legal requirements that we're required. I personally would make the motion to again approve a annual bonus to the plant administrator equal to 2 weeks of her current salary.
I'll second that.
Is there any discussion? If not, all in favor say aye.
Aye.
Anyone opposed? Motion carries. Discussion of an upcoming retirement, and I'm going to actually take this moment to make a presentation to a current retiree / former board member. You actually have 2 gifts, and much like this gift, the other gift is tomorrow being delivered, a day late. So I tried to go through and decide what you give someone who served on a board as a great thank you gift. And I said, what else than a cutting board? So we're going to present to you Brian Jones from the Longview Firemen's Pension, as a Longview Firemen's Pension trustee from 2006 to 2023. This beautiful cutting board, just in our appreciation of all the work and everything you put into this pension fund. Much like me, there haven't been very many good years until here recently, so it's been a lot of work, and I just want to thank you for everything that you've done for us and for everybody and all the members and retirees of the fund there. Thank you.
You're not cutting on this. It's been a long journey. JR, good luck to you. This has been you're taking over at a good time, because I took over at a time where I thought things were pretty good, right? Because within a year, everybody was gone when I came on the board. And that being said, it was, I thought, oh, wow, this is gonna be pretty cool. And then the bottom started falling out. Right after we made big plan changes, things started doing that. Then Colby came on, then Andy came on. It wasn't but a couple of years, we realized we were in trouble. And it's been the help of Angela coming on long-term. And then we've always had good board members, but I think we probably got the best collection of people now we've ever had. Vicki came on. John, you're a supportive, and you actually are here. That's good. I can say that now because I'm no longer a board member. Awake and so we appreciate that.
Asking questions.
And you have good, and you ask questions, and you have good. So everybody, we're set up good for the future. I've learned a lot that I can take to Port Arthur serving on their board. You know, not that they're stable and everything's going good, but it's an awareness that I know what to look for now. Whoa, hold on a minute, you know, and that's training me to go help other people. So if there's anything I can ever do for this board, Maria, thank you. You've been helping us with the books and making sure all that's right. And so anyway, I appreciate it. Thank you guys.
Thank you.
I'll be coming to the quarterly meetings because I need to compare numbers anyway. So, but, all right, thank you. All right. Y'all done with me?
Yes, sir. I think we're almost done with everybody. All right, discussion of upcoming retirements. I know we have a retirement off the books actually on Thanksgiving coming up that I believe is a vest term, or did he turn 50?
He turned 50.
All right, so he's going to start drawing no drop.
Yep.
His name?
Matt Bryan.
Matt Bryan.
His actually last day was yesterday, and he'll be on the books for Thanksgiving Day, and then Friday morning he comes off the books at 7.
All right. And I believe
So we don't have any retirements, but we have 2 that have terminated or just resigned that is coming up.
All right.
So Claude Dickens gave his 2-week notice, and then Jose Fuentes will be giving his 2-week notice in the near future.
Claude going to Plano?
Yep.
Claude is going to Plano.
That's where his boy lives. So.
Yeah.
Yeah, for family.
Yeah.
All right. Upcoming conferences. 2024 TechSpurs Annual Conference is April 7th through the 10th. It's at the Hyatt Regency in Dallas, Texas. If you have not got with Pam about this yet, this is a weekend of madness. Not because of the conference, but because of the solar eclipse that is coming through Texas. And there's like a gazillion people that are slated to come in for that Sunday night. And if we don't get your room booked before the room block is sold up, rooms will be selling for $15,000 to $20,000 for Sunday nights. So please, if you would love to go, let's get with Pam and hopefully get you in on that block rate. Otherwise, I'll try to leave a nice soft spot on the floor in my room if you want to bring a blow-up mattress for that Sunday. And other than that, I believe our next regular scheduled board meeting will be December 19th. That will be back at the pension office at 8:30 a.m. I will get with Pam and make sure that she forwards the information of both the quarterly presentation and the Kyle project and the proposed McKinney project to everyone to review between now and then. And I will make sure that we get Ari's contact information. Should anybody have any further questions, he's usually really good about answering questions on that. If nothing else, motion to adjourn?
Second.
All in favor say aye.
Aye.
All right, meeting adjourned.
Everybody have a happy Thanksgiving.